Good morning, everybody, and welcome to Business Depot's latest Calm Tax Convo. We're going to be talking tax planning. Of course, here we are sitting here today, the 31st of May, 2023. We've got a month to go. We've got 30 days left to get sorted to 30 June 2023. As we always say, it's really hard to do tax planning after the event. So that's why the next month is most important for us as well. Of course, my name is John Knight. I'm the Managing Director here at Business Depot. Joining me today, we have Jacquii Reeves, our Head of Tax. Welcome, Jacquii.
Thanks, John.
And of course, Rebecca Mihalic, our Sydney office. She's going to join in and chime in with her insights today as well. Welcome, Rebecca.
Thanks for having me, John.
Look, let's just get straight to the point. We want this conversation to be very casual, very flowing. Obviously, there'll be more detail that you might need to understand in your particular situation. But what we're trying to do here is just to cover off on the key things to think about between now and 30 June to make sure you're not paying $1 more tax than you have to. And so I thought we might start with you, Jacquii. And obviously, we had our budget earlier in the month, and some of you would have seen our breakdown of the budget. What are the new things overall, budget or not, that we need to be aware of as we go into 30 June 2023?
Yeah, so I think we've been publicising the ending of temporary full expensing in not only just our budget blogs, but other blogs that we've been doing in year end, just as a reminder that 30 June 2023 is the end of full expensing, where basically for most of our clients, turnover of less than 5 billion, you could write off all of your assets, but also for our guys in that under 50 million turnover, could write off secondhand assets that they'd acquired and installed ready for use. So just a reminder that is going back to pre-COVID measures from 30 June 2023. So it'll be a $20,000 limit per asset, pending those assets aren't aggregated, and turnover of less than 10 million. So you'll be putting your assets back in your fixed asset register from 30 June.
Yeah, so I want to be really clear on this because this is one of the biggest ticket items going into 30 June this year. If you're buying an asset, in the last couple of years, you've been able to 100% write that off, provided your turnover is less than $5 billion.
Yep.
Now, it needs to be, what's the correct terminology? Installed, ready for use before 30 June?
Yep, installed and ready for use. Yep.
So if I'm buying a truck for my transport business or something rather, you need to have it delivered and available to get a deduction for that in this financial year.
Yeah, and I think that's why we have been publicising that in a lot of our blogs, and especially in the vehicle market, is that you probably had to have those trucks and cars and equipment on order 6 to 8 months ago. So for most of our clients, they've been aware of this and we've been having those conversations. But it's just if you need anything else pre-30 June, like some upgrades to certain things, and you're going to do it in July, then maybe bring it forward so that you can write it off.
And so then after 30 June, what's the turnover threshold?
$10 million.
So you have to have less than $10 million. And if you're a group, that will be a group turnover test, I assume. And the limit is $20,000 that you can claim a tax deduction for.
Correct.
Okay, so it's a dramatic change in the instant or temporary full expensing, to get the correct terminology. What else is new going into 30 June?
Yeah, so the temporary full expensing measures went hand in hand with the loss carryback rules, because the intention of that was that people would go out, spend a lot of money on capital, on CapEx, put some money back into the economy. And if you'd made profit in prior years, then the losses that potentially that temporary full expensing generated, you could carry it back and get, some of your tax that you'd paid back in prior years. So just a reminder that that's ceasing 30 June 2023. There's not really too much that we can do about it, but, it's just probably a note to say if you've made losses this year, you can still look at loss carryback.
But it's going to end at 30 June.
Yeah, and so the other main thing I just wanted to talk about, and I know when we talk in the budget blogs and in our videos that we've done for that, is the 20% additional deduction for certain expenditure that are being called the boosts. So it's the skills and training boost, the technology investment boost, and in the recent budget, the energy efficiency boost. So they're not yet law, but they will apply to some certain expenditure in the 2022 and 2023 year. but to be included in the 23 tax return. So I think just the message there is that if you've spent money on that, keep your records, make sure that it's aware. Once it's law, you'll pop it in your tax return, but it's an extra 20% tax deduction. And I think we've talked about the calcs on this. It's not too excited.
I really struggle to get excited. If I spend 10 grand, I get an extra 2 grand deduction, which is worth $500 to me. Is that correct? So you got to spend 10 grand to get $500. I don't know. It's better than nothing. So if you're going to spend it anyway, then you
spend it anyway. Yep. I think so.
We've got some STP changes coming in 1 July as well, don't we?
Yes, everyone will be aware that STP has been evolving over the last however many years since it was introduced. And what they're looking at now is that the STP reporting will automatically pre-fill into your, your instalment activity statement. So you what we call our W1, our wages paid, and our W2 figures, which is the tax withheld. They're going to be automatically pre-filling from your STP data. From 1 July. So I think it's just important that you make sure that your background payroll system's working, your STP is working. And I think as we talked about in the budget webinar around payday superannuation coming in the next few financial years, is that with STP, this probably was the next progression, is that, they're probably going to want, super guarantee paid on payday, and then, yeah.
I should have said STP, single touch payroll. Rebecca, there's a few changes with personal deductions as well. We're sort of coming out of this post-COVID sort of era. At a high level, what are some of those personal deduction things that are going to change at 30 June as well?
There's some good and bad stuff depending on where you sit. There was an offset called the low and middle income tax offset that's coming to an end. And that's not going to be eligible anymore for people who earn between, I think, $66,667 and $126,000. Used to be eligible for this offset, no longer. If you have income below $66,000 odd, you'll still get the low income tax offset only. Self-education, this is a good measure. The $250 reduction that you used to have to self-education expenses is going away. However, don't forget, you still have to have a nexus between your current employment and the education expenses to claim it in the first place. Cents per kilometre, reflection of the fact that everything's costing a lot more now, has gone up to 78 cents, but you do actually need to justify the kilometre claim that you're doing. If you year after year claim 5,000 kilometres, expect a review from the ATO at some point, and make sure that you can substantiate the kilometres you are claiming. Work from home, so the shortcut method that was available if you're working from home during COVID is now gone, and the fixed rate method, if you're claiming work from home expenses, is 67 cents an hour now. There have been a couple of other changes. You no longer have to have a dedicated office space to claim working from home deductions, but you do need to keep a log of the hours. So not just an estimate, say I work 10 hours every single week, actually keeping a log of what's going on for your claim, so it's a lot more accurate. And probably just a last thing, just a reminder that there are no changes to the personal tax rates yet. There's still to come, and make sure you keep all your receipts, because we can't help you if you haven't kept your documents.
Yeah, so the scrapping of the low to middle income tax offset is actually going to result in more tax payable by all individuals between $66,000 and $120,000 worth of taxable income.
126.
Yeah, mind you, 1 July 2024, there's quite significant tax rate changes which will counter that. I think quite significantly. If we talk then about focus areas, what's the tax office looking at the moment? I might stay with you, Rebecca, if you don't mind. And maybe from that individual sort of perspective, what should people be worried about from the ATO?
If you are claiming work from home expenses, and it is understandable in this current environment coming out of COVID, there is a lot more work from home across all industries. So there is an expectation that will increase. Make sure you are keeping all of your documents. It will be a higher target area from the ATO to really review whether or not you're legitimately working from home and can substantiate that. Also, that you're not claiming expenses that your employer has already reimbursed you for. So if they're paying for your telephone or internet or something like that, make sure you're not double dipping your claim. Holiday homes and rentals, the ATO has gotten quite concerned about the level of claiming for holiday homes when people are listing them through something like Airbnb, and it's sort of rented sometimes, and you might have it up the whole year with this intent to rent or available to rent concept so that you can claim all of the deductions all year. They're going to be looking at that a lot closer and making sure that you're not listing it at a ridiculous amount that cannot be rented out, and that it is genuinely available to rent, and probably looking at just apportioning your claims for periods of time moving forward that it's actually being rented out. So that they have cottoned on to what people are doing. For sure.
They're well and truly onto that one, aren't they?
Yeah, and probably the last thing, super contributions. If you are making personal contributions, there's been a little bit of leeway in previous years around the timing of lodging your intent to claim forms. Make sure that you get them in on time. So if you want to claim for any superannuation deductions, they need to be in by 30 June 2023. If you're claiming for the 2022 year, so if you're claiming for 2023, your amount has to be in by 30 June 2024. Is that right, Jacquie?
Yeah, good. Guys, I should have mentioned earlier, happy to take any questions throughout the conversation here today. Please just ideally use the Q&A button down the bottom on the webinar, and we'd be happy to take those questions. Anything we can't answer live, we'll obviously come back to you at a later date. What about from a business perspective, Jacquie? What is the ATO focusing on? What should we be paying our attention to?
Yeah, so I think just as Rebecca was talking about, probably holiday homes, rentals ties into kind of individuals and business perspective, because they might be in trusts as well, or companies, is capital gains tax. So there is going to be a big focus area around CGT events and disposals for the 2023 year and probably going forward. And I think this is just making sure that all assets are captured. So that includes, your cryptocurrency trades, if you've got shares, if you've got rental properties, if you've got, overseas assets that you've disposed of and you're an Australian resident. It's just making sure that all of those are included. And the ATO does data match a lot of that information as well. And I think the main key area that they want to focus on too there is around main residence exemption. So just a reminder that if your main residence has had a dual purpose, you might only be able to an apportioned main residence exemption. Or if you've had two main residences where they've straddled more than a 6-month period, or you've had one where you've moved in, you moved out, you moved in, you moved out, you do need to, either select one as your main residence and then apportion the other. Main residence rules get a bit complex. So
does this get into situations also where maybe it was a rental property at the beginning, but then I moved into it and renovated it and now I live in it, and they just conveniently forgot that it was a rental property in the early days?
Yeah, that's right. And there's different ways that you apportion under the main resident rules too. Some of them, if it was your main residence first and then it goes to rent, that you can sometimes get a market uplift on that. That becomes your new cost base once it's brought into the CGT net. But if it was rented first and then it becomes your main residence, it's always days apportionment. And there's some fairly complex rules around that. So I just think you've got to, just because you've lived in it, for a period of time doesn't always mean that you'll get the full main residence exemption.
Okay, what else, Jacquie? What else should business owners be
and if I can just maybe talk about that just very quickly, I'll try to keep it brief, John. You know how I like to go into detail, but just a reminder, we've had a lot of, it's happening a lot more frequently around where people are like, okay, well, I'm going to buy a house, I'm going to develop it, I'm going to live in it for 6 months, and then I'm going to flip it, and then I'm going to do it again, and I'm going to do it again, and I'm going to do it again. And they're like, okay, I can get main residence exemption, or it's on capital account. I just think this is a real focus area for the ATO in terms of, are you actually doing a development activity, or are you actually holding something for long-term rent and capital growth? So I think it's just getting advice on those projects, because the other thing is that if it's a new residential property, then you've potentially got GST issues as well. So don't listen to the pub talk on flipping properties that they're always on capital account, because chances are it's more murky than that. Another lot of focus area is unpaid superannuation and pay-as-you-go withholding. We are seeing a lot of focus area. We've seen a lot of super guarantee charge reviews coming through. Reminder that if you're paying by a clearinghouse, that you need to pay, I would say, at least 7 days prior to the 28th day of the end of the quarter, because the SGC penalties are severe, and it means that the superannuation paid is not deductible if it's paid late, so it can be very costly. So my recommendation would always be is if you're paying quarterly, if you're on quarterly super contributions, at the end of the quarter, once you've finished your payroll, 2 or 3 days later, reconcile and pay to avoid any late paid SGC.
Yeah. We have seen a lot of ATO activity around this, and it's something that comes up a lot in M&A activity as well. So when someone's selling their business and then they look and the buyer looks at it and they sees that they've paid super late, it's a risk that they often won't take, and they'll make you pay any penalties and so forth for the sale to go ahead.
Yep.
What about TPAR? What's that acronym?
Yeah, so it's taxable annual payment report. So for those who have to prepare these reports, it's anyone who uses subcontractors, but they target certain industries, predominantly construction and security and a few other industries. But it's basically, if you engage a subcontractor, even if it is a genuine subcontractor arrangement, you have to submit that taxable annual payments report by the end of August each year, I think it is. And that's just so the ATO can data match that subcontractors, including that in their income. I am seeing a lot of people just go, it's an administrative burden on behalf of the employee, on behalf of the business, and a lot of people just forget they've got so much else going on towards that time. But I'm seeing a lot of penalties issued in respect of those.
ATO is always loving to talk about the cash economy and how they're going to find some tax in there. They're still talking about that?
Yep, I don't think the cash economy is going to go away anytime soon. I think it's always going to be a focus area. And when the ATO tend to get funding, it's predominantly for these types of areas.
Oh, look, and there seems to be no doubt that the ATO has increased their activity around recovering debts and so forth as well. So We're actually seeing them using director penalty notices again, more aggressively. Do you want to just explain very quickly what a director penalty notice is and what you need to do when you get one?
Yeah, so if your company and you're a director of that company has an outstanding GST super guarantee pay-as-you-go withholding debt and you haven't paid it and you've just ignored the ATO correspondence, then you as the director can be personally liable for those amounts. So what happens is you get a director penalty notice and you'll then have a debt raised on your personal income tax or integrated client account, and that director penalty notice does not go away until the debt's cleared. So I think if you get a direct penalty notice, talk to us. We probably then need to, be dealing with the situation. But my preference is don't get to that situation in the first place.
And you have to act really quick, don't you?
Yeah, get in touch with the ATO. If you've got debt, we know a lot of clients out there have had debts accumulating since COVID. Get on the front foot with the ATO. Try to get a payment arrangement. See if there's any alternatives. Just don't let the debt keep mounting because you will get direct penalty notices.
Yeah, okay. What about attention around cybersecurity and some of that type of stuff? Is there ATO sort of, we've got the ATO scammers out there as well, don't we, that we've got to watch out for? What do you think we need to know about as we go into 30 June around this?
Yeah, look, I think it's just making sure you're keeping your personal information safe, you're keeping your tax file numbers safe, that sort of stuff, and making sure we've seen a little bit in the way of like cryptocurrency scams where, you're going to invest in a platform, but they're actually not from, that cryptocurrency platform. You're losing your money. But the hard thing there is, and the ATO have some fairly decent commentary on this, is that if you give away that money and you actually didn't own the underlying asset, then you don't get a capital loss on it. and potentially no revenue loss either. So basically your money's gone, and if you took the money from your private company to borrow it, then you've got a Div 7A issue as well. So really bad tax outcomes with some of this stuff. But I think it's not just crypto, there's other things, that people need to be aware of. It's just making sure you've got good email security, you're keeping your password protected. If it looks like a dodgy email, just don't respond, don't click on links, and double check before you do.
Now, Rebecca, one of the most common tax planning sort of discussions is around timing of expenses or timing of income. What do you think we need to know going into 30 June from a tax planning perspective around that?
Well, if we focus sort of on the expense side of that, small and medium businesses and their related parties, if they have turnover less than 50 million, you can actually claim immediate deductions for some prepaid expenses. So if there is cash floating around in your bank account and you're going to pay for certain things next year, you might want to consider doing it this year to bring the tax down. Remember that those items that you're paying for must be a deductible expense anyway to the business. So thinking about things like maybe prepaid IT maintenance, prepaid interest on a rental property if you're looking at something like that personally, prepaying your accounting fees. We would never say no to that over here. But remember as well, if you do prepay some of these things, if you don't do it again next year, it'll catch up with you because you won't have that deduction. Sometimes people get a bit stuck like that. They might do it this year, not do it next year. So the profits next year will actually be a little bit inflated because you've already prepaid and claimed some expenses in the current year. So just understanding the cash flow impact of this as well is important.
Okay, is there any threshold on who gets those prepayment sort of deductions?
Yeah, so it was small and business entities up to $50 million turnover.
Okay.
Yep.
And what else from a timing perspective? What about like if you want to pay some bonuses to your staff or something like that?
Yeah, if you want to pay commissions, bonuses or wages, and if you're paying those items, say monthly or fortnightly, and it doesn't actually land before 30 June, you can accrue that before 30 June, so long as you are legally committed to paying that, which becomes mostly important when we're talking about like bonuses and commissions, making sure that that is actually earned and you have a legal commitment to pay that to the employee before you accrue it before 30 June. If you're unclear about that, please reach out to your accountant before just going in and putting it in your accounts to talk that through.
Does that require the business to be on an accrual system rather than a cash system to get that deduction?
Absolutely.
Yeah. So if you're on accruals and you've incurred, let's say you're a real estate agent, you've got a lot of salesperson commissions you're definitively committed to, they will be deductible even if not paid before 30 June. But if you are just paying a discretionary bonus and you pay it in July, you won't get the deduction until the following year. So you must pay that before 30 June to get the deduction.
And just remember as well, that only relates to the payment of like the accrual amount of the bonus, not the on cost of superannuation, because you cannot claim that unless it's physically paid.
Yeah, well, I mean, it's something that people keep forgetting about. Your super is not deductible until it's physically paid. And so more and more, the time gap that the clearinghouses are asking to make sure that super is paid seems to be getting bigger and bigger. When are we advising people to pay their super for the month of June to make sure they get the deduction for it?
Well, if they're using an online system like Xero or any of the major clearinghouses, the dates that they've all put out is the 10th of June to clear in time this year. So that is less than 2 weeks away. So really getting on top of that to make sure you've got as much of your super paid on time. And don't forget, it's not just about paying it before 30 June. It's also not deductible if you've paid previous quarters late. So on-time payments and before the end of the financial year consistently with super.
Yeah, very good. Now, Jacquie, Rebecca talked about income timing considerations at 30 June. What about, expenses timing? What about from an income perspective?
Yeah, so I think when we come to tax planning, people always want to talk about, push out income into the next financial year. If, then you're paying tax on the next year. I think you've just got to remember that it's not just a simple matter of, don't raise an invoice pre-30 June for the work because then we can push it to the next year. One, if you have a really good year the next year, you're basically just pushing it into the next year. You're just kicking the can down the road. But also from a tax perspective, is that income will be derived in the period that you provide the services or the goods. So just not invoicing it is not enough as far as I'm concerned. If you've received income in advance, then I think that's a different story. And sometimes when you've got service agreements, you do pay in advance. And so normally that unearned income won't be accessible until you perform the service. And the only exception to that is if you've been paid up for a service, and regardless of whether you deliver it or not, or you've collected a deposit and you haven't delivered the goods, if you get to keep that deposit or that unearned income, then it's accessible straight away.
Essentially it has to be refundable if the contract was cancelled.
Yep.
Okay, so to be the unearned income. Okay, good. What about bad debts, Rebecca? That's one thing, 30 June every year, everyone should review their debtors. Is there anything bad in there? What does it need to be considered bad and deductible?
If it's a bad debt, and I think that businesses probably need to really be looking at their receivables or their trade debtor ledgers in detail this year, for it to be a bad debt, it really needs to be unrecoverable, and you have to have a justifiable reason around it being unrecoverable. Maybe your customer has gone into liquidation themselves, or you've been chasing it for a long time with no communication, some record on file around the fact that it is not recoverable before you can write it off, not just something that hasn't been paid in a while. And in particular, like if we're assessed that and then we can see you have actually added it back in a couple of months and received the payment, that's not on. So just making sure it's really those customers or clients that aren't able to pay you can't contact them, definitely not recoverable. And don't hesitate in that instance to actually let us know or write them off yourselves. There's no point paying tax or GST if you're on an accruals basis if you're never going to receive that money.
Yeah, okay. And stock, Jacquie, got to do a stock take every year, don't we? I know some people don't like doing their stock takes, but if you've got stock, you need to be doing that every year.
Yeah, and I think stock is one of those really important things leading up to 30 June because there may now be obsolete stock or damaged stock. And you also do have the different methods to value stock. So you can do it at cost, market value or selling value. Sometimes with stock, particularly if you've purchased it at a specific rate and then the market value of that stock has dropped, potentially you can have different outcomes in relation to that. So keeping really good records, and most people do, they've normally got a stock or inventory system that runs that, but doing a physical count, seeing what you've actually got on hand, because you might actually have some missing or lost stolen stock, obsolete stock, and you want to be able to get a tax deduction for that amount.
Yeah, so your stock basically becomes income. So if there's anything you have to legally be able to reduce the value of that stock within the obsolete rules or the different basis, then you want to keep that down, don't you? We touched on CGT a little while ago, Jacquie, but the one thing people still seem to get confused on is that capital gains tax is assessed on contract date, not on settlement. What do you want to add to that, or what consider if someone's got a capital gains tax event that they've incurred in this financial year? What are some of the tax planning strategies?
I think if it's through a trust, then it's making sure that your trust distribution minute is correct and completed pre-30 June, because if in the unfortunate event that capital gain gets distributed to a company, then you don't get CGT discount. Also, if you don't fail to make a resolution and it gets assessed at the trustee level at 47%, you don't get CGT discounts. I think it's really making sure you tell your advisors, hey, I've had a capital gains tax event throughout the year. I do normally, when I'm doing my trust distribution minutes, is include a distribution for capital gains anyway, just to capture individuals to get CGT discount, just to make sure that we're capturing for those unknown events. But the big thing is around things like small business CGT concessions, is that it's not just the timing of the event, but it's making sure that you get your distributions right as well, because you have to have a CGT concession stakeholder, which is basically someone who controls, it's a mathematical way that you process as to where it gets distributed, but there is some complexity in those rules. So I think getting the advice up front before 30 June.
Oh yeah, I'd hope if you've got small business CGT possibilities, you've already received your advice, maybe even before you sold that asset anyway. They're staying on the timing issue. One of the things I constantly bang on about is watching out for the double whammy of tax. This is essentially your quarterly tax system, and as your profits grow, a lot of people have lodged their 2022 tax return, although I know many of us are behind our schedule on that and begging the ATO for extensions and so forth, which is just the reality of the industry at the moment. The 2022 tax returns are getting lodged. They're getting big tax bills from 2022. Then their June PAYG instalment is going to go up in line with that. And so we're at that point in the tax timeline where there's going to be some people hit from now through to July, August, with effectively a double whammy of almost 2 years worth of tax in one go. We've also got changes with super from an SGC perspective as well, don't we? I think that goes up to 11%, 1 July, ladies. Yep. And what about from a personal perspective? What do we need to worry about from a tax planning perspective to get a deduction for super contributions?
Yes, I think Beck talked about making sure your business contributions are in by the 10th of June for staff to get a deduction. But for personally, if you're making a personal super contribution, then the caps are 27,500. I would probably be making those around the 10th of June as well, even if you are direct depositing, because you want to make sure that you do get it in on time. Making sure you do include, prepare those notice of intent to claim, ideally with the lodgement of your tax return or before, or at least prior to 30 June 2024. A reminder that we have the rolling balance caps, which was actually a fairly decent, budget measure a few years ago, where if you haven't been making the top contributions each year, is that those caps can roll into the next year. They're really great planning if you've had something like a big capital gains tax event sold out of your business, is that you can roll those forward. But your prior year super balance has to be under 500,000. And just a reminder too, don't always just go off what's on the ATO portal or on your MyGov account, because sometimes that data might not have been reflected, particularly if your super fund hasn't been, completed on time or something like that. So make sure you go back through your contributions that you've claimed. Sorry, go John.
I was just going to say, and of course, always speak to somebody, a financial planner or somebody to advise you on your superannuation. There's also the bring forward rules for non-concessional, so the non-deductible contributions to do 3 years. And also just keep an eye out for what we call Div 293 tax as well. Whereas if you have had a super contribution and your taxable income plus your super contributions is more than $250,000, you're going to get hit with a bit of extra tax, which takes the benefit out of the super contribution a little bit as well. But make sure you speak to someone like Megan or Simone from our financial planning division to talk about that. Okay, FBT on electric cars, that's starting to get a bit of interest, Rebecca, bit of excitement around this one.
There is a little bit of excitement about it. I'm going to go into heaps of detail. We have a great blog on the website. Please check that out. However, just to note that to get an electric vehicle that is exempt from FBT, it must be zero or a low emissions vehicle. It must never have had luxury car tax paid on it, so below the luxury car tax limit, and must have been purchased after 1st July 2022. Now, a little bit of warning about that. While that might be an FBT free vehicle, if you satisfy all those conditions, it's still a reportable amount. So even though the business doesn't need to pay FBT, it will still be reportable on the for the employee. So it will impact things like family tax benefits and other government payments, as it'll be noted on your tax return.
Okay, but yeah, a tax exempt or an FBT exempt vehicle in the company is pretty interesting. It probably rules most of the Teslas out there all over the luxury car threshold, aren't they?
Mostly.
Yeah. Two of the topics we talk most about at tax planning time is trying not to use acronyms, the Division 7A loans, so the shareholder loans, and what we call Section 100A trust distributions. Jacquie, give us a quick rundown on those two things and what's important to consider before 30 June.
That's a joke when you say quick when you're talking to me, John. Sorry, I get excited about these things and I Yeah, that's why John's in the background wrapping me up. But most of us will be aware, Div 7A, I know we use that acronym, we throw it around all the time. It's the section reference to the Tax Act. But what it basically means is if you've got a private company that has retained earnings, you've paid tax at the 25% or the 30% tax rate, and you as a shareholder or an associate, and those associate provisions are very broad, basically anyone in your family or a trust or company that you control, if you pull that money out of that company, you're going to be subject to these rules. And basically you have to repay it over a 7-year period with interest. Now with the increase in interest rate rises, those interest rate, benchmark interest rates are increasing. They haven't released the rate for 2024 yet, but I'm estimating it's going to be somewhere around the 6%. We've been paying around 4%. And if you've gone and used that money from that private company personally, that interest is not deductible to you. So your company's paying tax on the interest and you're not getting a personal tax deduction. So I think it's just watching those rules. Now, John, with Division 7A and the private company rules, what we see a lot in our client base and people that I talk to is the company's the one with all the money, it's generated all the profits. And then they go, okay, well, we want to invest that. We want to go and buy a commercial property, or we want to go and buy some investment properties. And we're just going to take that money out of the company and lend it to our family trust. Well, that's subject to Division 7A. You've then got an aggressive repayment schedule over 7 years. Yes, the interest is deductible, but you've got to match those repayments, usually by dividends out of the company, and paying top up tax on those dividends. So we're seeing more planning coming along our clients where they're long-term holds. And they're going to hold them for capital growth over a long time. We're seeing a lot of people invest in company structures. Yes, you don't get access to the CGT discount, but you can repay debt at a much faster rate at the corporate tax rate. So I think it's just having planning around that and being able to manage it.
And I think what you're talking about there, Jacquii, is really, that's the ultimate tax planning strategy, is get your structure right from the beginning. Often where people end up paying more tax than they should otherwise be paying is because they're in an old legacy structure. And what you're saying there about changing the way we look at where we should invest from is, I think, one of the number one topics that we're talking about to our clients about. And instead of just doing the natural capital appreciating asset within a trust, we're more and more investing in a company structure, even if it's a capital appreciating asset. It's a bit like, I describe it as, it's a bit like setting up your family office, where you think about it like a company and you make investments in there, and you're not necessarily intending to take that money out of that company down the track. You get the benefit of not having to pay, not having to worry about Div 7A or worry about the catch-up tax. And so it's a real compounding benefit on the tax.
Yep. And the reason for that is, John, just to throw that in there, is that when companies loan to other companies, Division 7A doesn't apply except in very limited circumstances, like if you're pulling cash out of the other company that you've loaned to. And
then correct me if I'm wrong, but the other big thing we're looking at 30 June with Division 7A is making sure they've met their minimum repayments on old Div 7A loans. And these loans accumulate, and those minimum repayments that have to be paid, which we usually do by way of dividends, do get bigger and bigger and bigger. And no one wants that big catch-up tax amount.
Yeah, so I think it's having some planning around those, and we are having a lot of conversations with our clients in that space to make sure that we're just having some future thinking about planning, because you can put some of those, some Division 7A loans on a 25-year loan agreement. So say you've gone to buy the commercial property, but it has to be secured over that property, and you've got to register the mortgage. The property has to be valued at more than 110% of the loan value. And I think the important reminder there is that the Board of Tax and Treasury did release, their review of Division 7A, and they were talking about scrapping 25-year loans. That hasn't been law, nothing's been moved at the moment, but I think it's just, don't always think, okay, well, we can use a 25-year loan agreement. You'd get it in place for now if you could, but just a reminder that the government could actually scrap that at any time, because it was one of the Board of Tax's recommendations.
And then one of the other hot topics that accountants are talking about at the moment is the Section 100A rules, or I think they've basically released their interpretation of it to widen the net. Do you want to just explain to us what we're watching out there for everybody?
Yes, I'm not going to go into too much detail because this is a very complex area of tax and trust law. But basically what Section 100A says is that if the trustee makes a distribution to an individual and prior to that distribution you have an agreement for that beneficiary to not receive those funds, then it's as though that distribution never had and the trustee gets taxed. So an example of that might be, John, you and I are in the same family group, we've got income and you've decided to distribute $100,000 to me because I'm on a lower marginal tax rate, but we have a side agreement in place where I'm actually going to give you those funds back. That's effectively without getting into the technical, that's a reimbursement agreement.
But it could be to my daughter too, couldn't it? It could be to my 18-year-old daughter and I don't intend to give her the money.
Yeah, that's right. And so the reason there's a lot of ATO focus in this area, and they have put out their practical compliance, which is where they're going to dedicate compliance resources to target these areas. They've put out some taxpayer alerts, is in situations where you're distributing to adult children or maybe it's adult parents and there is no intention for them to ever receive that distribution. There is a carve out in those rules, which is ordinary family dealings. But as we're seeing with some of the cases around 100A that are going to the High Court, or some of the matters that the ATO are looking at, it's really hard to describe what an ordinary family dealing is, because what's ordinary in my family might not be an ordinary in your family, might not be ordinary in Rebecca's family. It's very different. But I think the thing that we just have to be careful is that you can still distribute to adult children. Trustees make those decisions pre-30 June. And just don't have an agreement to offset. If later down the track, as the adult person's doing their tax return, they go, okay, well, I've now got an unpaid present entitlement, which is an indefeasible right to that money, like they can call on that money. If the trust has paid things like their university fees or a car or an overseas holiday or their tax, my preference would to see those amounts being paid out of the trust and the adult person agreeing to say, yep, you've paid for those, so that reduces my UPE. If the parents have paid for them, those sorts of things is just making sure that, if you're going to offset, that it's documented, you've got evidence that they've spent that money, and the adult child, after 30 June is aware of that distribution and they can call on it.
Yeah. So really, it's just a flag that we're sort of saying this is getting attention, and you need to be thinking about this in your tax.
Yeah, and the taxpayer alert was very specific around. I've not seen this happen in practice, but where people in their family trusts are paying, daycare fees and primary school fees or overseas holidays when the kids are like 10, and they're just building up these loans owed by minors with the event that when they turn 18, they'll give these distributions to the children and they won't ever have to pay the cash. And I think there is real concern about that because, a minor can't really make that decision. So I just think normal strategies where we want to give the kids distributions, they're using the money, they might leave it uncalled for a period of time because they might just want to leave it sit there till they go and buy their first family home or something like that. I think it's having those things documented, but if it sounds dodgy, then just don't do it. I
think the key is, if you're going to distribute to them, you've got to be willing to spend it on them.
Correct.
Make sure you track what you'd already spent on them as well.
Yeah, correct.
Most of us probably spend a bit on our children if they're under 18 years of age. The other area that constantly is getting talked about in the tax circles is professional services firms. I don't think that there's a new release during the year and so forth, but I think from a tax planning perspective, you've just got to make sure that the professionals get a decent amount of income allocated to them. Is that correct? Yeah. Or is that how you'd sort of just hit that one?
Absolutely. There's some sort of ranges that are given. I think it's like a traffic light system that you're having a look, whether or not you're at risk or working within the rules that are acceptable. We can work with you figuring that out.
Don't push the boundaries too far. Just make sure you are ending up with a decent amount of tax in your own name personally, being a professional. Ladies, thank you so much for your insights and your intel there. Obviously, 30 June's just around the corner. We've got lots of work to do to make sure we minimise your tax before 30 June for this financial year. And I know for many of us who are probably running a little bit behind with things, we apologise for some delays in that. But at the same time, we need to focus on the tax planning as the most critical thing, because it's got that time that is absolutely something we can't get back. Do you guys have a final tip for our audience here today? Rebecca, I might start with you.
You did mention the double tax whammy. However, I just want to remind everybody that the relaxation around penalties if you aggressively vary down your instalments is now over, now that we've come out of COVID. So please don't aggressively vary down your instalments if it's not appropriate, just to manage your cash flow. Talk to us, we will help you come up with another way.
Thank you. Final tip, Jacquie?
Just always constantly talking to your tax advisor. You know, like tax planning strategies starts with structuring and getting advice right from the outset, or being able to help, you know, roll into a new structure, etc. So I think it's just keeping us abreast of all of those issues to be on the front foot. Secondly, I think there was an unanswered question in the chat.
Sorry.
No, I accidentally answered it. It's me, technology. But I think if JC, if he just wants to touch base with me, I can have a chat to him and talk him through that.
No worries. And look, my tip would be very similar to yours, Jacquie. Just make sure you talk to your advisors. Make sure you're talking to them earlier, the better. Don't leave it till the 30th of June. There's very little we can do on the 1st of July. Guys, thank you for those that popped on the call, and of course anyone who's watching this afterwards as well. Thank you for chiming in. If you do have any questions for Jacquie, Rebecca, or any of our team, whether it be your usual advisor here at Business Depot, or if you're a new contact, feel free to reach out to either of us or via the website at 1300 The Depot. Thank you, ladies.
Bye.
Thanks, John. Thanks, Rebecca.